India's promoters, the ultimate insiders, have been steadily selling down their stakes. And this isn't a short-term trend. Over the past 4 years, data shows that a clear trend of exits of promoters is accelerating. Promoter holding across listed companies is falling.
Promoter stake sales touched 1.16 lakh crore and 1.1 lakh crores respectively. This is almost double the amounts seen just 2 years ago. In 2025, we've already crossed 64,000 crore rupees. And by the way, it's only July, so you got half a year to go. As a result, private promoters' shareholding, if you just look at these numbers, how it's impacted their shareholding across listed companies on the NSE, it's steadily declined. From 45%, which is what private promoters held at the end of 2021, it's now come to under 41%. That's about 4.5% percentage point drop in just over 3 years. It's massive. On the flip side, where has all this money gone? Domestic institutional investors, powered by largely SIPs, have been stepping up with their shareholding, which has risen from 13% to over 17% in the same time period. So it's almost a transfer from promoters, private promoters, to institutional shareholders, which is largely DIIs, right? That 16 lakh crore has all but disappeared, and then some. DIIs actually now own about 1.6 lakh crores in listed equities more as compared to FII. So actually, it's been an absolute dramatic change in terms of the composition of the market, even within institutional shareholders. And DIIs have really emerged as the big kind of block which has absorbed a lot of this supply which has come in.
Put it very nicely. The data is absolutely crystal clear. That trend is building up, and one of the things you said in the beginning. So retail investors are giving a floor, the resilience to the market, and the promoter selling is going to give that. It is going to save the market from melting up. So that's a fantastic thing to have, because this one it avoids a crash in the market. It also avoids the melt up in the market. Okay. Second, and this gives a sustained expansion of the capital market activity. Because if you have floating stock of say 30%, or there are a lot of companies there are 25, or government companies there are 15, 10% is there. So your activity is going to be small. But as your floating stock, which is now 60% on aggregate basis, floating stock goes to more like 75%. So what happens is that all the market intermediaries, one is the index, because of index expansion, say by 12-13%, and other is the volume expansion by 4-5%. So more customers, more stocks to trade, and of course the tailwind of economy, which is sustained at 7%. So I think it's a complete Goldilocks kind of situation, because in the stock market, any kind of melt up is borrowing from the return of the future, which creates problem. Now it will be very good. In next 4 to 5 years, 6 years, will become 10 trillion large market, and it is required. This kind of liquidity build-up is required, because we've got tons of small companies. If you have 60-70% owned by the promoters, how, where is the depth? A lot of fund managers, they won't be able to participate in those stocks, because whenever you go to buy, the impact will be 10%. When you go to sell, it will be 15-20%. So that makes the market very primitive. So this is the best market, yeah.
So it's a sign of market depth and not distress.
No, not distress for sure, yeah.
So what are the broader implications of this? You spoke about how that this is a structural positive for everything related to capital markets.
Currently promoting a very large, kind of new ventures in the family members or themselves, say, and unrelated family ventures. So basically, if you are a textile company and you want to get into steel, now you would not like to diversify within the textile company that particular thing. You sell 5-10% and promote for 1,000 crores, 2,000 crores, another equity base, and promote a new venture. So a lot of these possibilities are there. Wealth effect will be there. You can consume, you see all these 400, 200, 300 crore flats being bought. They're all coming out of the market cap melt down, whether it is IPO, whether it is QIP, whether it is actual selling. So wealth effect has to come. We are sitting on, our annual wealth change, just by numbers, is running into 25 to 30% of GDP. And yet we are struggling for 1% extra growth, because consumption is not happening. So I think it will give some boost to the...
and those 300, 400 crores flat purchases is coming at... Earlier it used to come at 5-6% of company equity. Now it's coming at 0.5%, 0.4%.
Yeah. That's the power of, kind of fair or rich valuation of the market.
Yeah. Capital markets has been your favorite area.
Yes. So I can see what happens. One is that, of course, one time the deal value and then some commission you make. But that's the smallest part. Immediately this money comes in wealth management. So wealth managers, they get the corpus. So 2, 3, 4 of them will be nominated and everybody will get very large chunk of, you can see large deals and all the money is again coming back to the market. So actually at one level they provide the melt up against the melt up and again they come back to give the flow to the same market by diversifying the portfolio.
Correct.
So that activity is, so it expands the wealth management platform, it expands the AMC platform because wealth managers, they allocate the money to the mutual fund products or private equity products. So every aspect of the capital market activity will get a boost the moment that share certificate melts.
Feroz, on the subject of setting up family offices, how much of the money, to your mind, is fed back into the capital markets, re-enters the capital markets?
Yes, Rima. Before I go to that question, on the previous topic, I have 3 important points which I want to make. And I really pray Ramdevji's 25% happens. Because in the S&P 500, we are looking at close to about 80% of the companies have 100% free float. And we have not more than 10% of them who have more than 80% free float. There are only 6% of the companies who have more than 90% free float. We are a country with promoter holding, financialization happening. If there's a paradigm shift and there's capital movement, we are a country with 940 lakh crores of household savings, adding 40 lakh crores, out of which only 6.7% is in equity. And largely top 500 companies, because that's what is mandated to domestic institutions as their tier 1 benchmark. So if there's no promoter holding, there will be bubbles, retail will lose money. That's point 1. Point 2, if I personally think that there's hardly any promoter selling in NSE 500 companies, let me put some math to that table. Out of the Nifty 50 companies, 5 of them have done a stake sale in the first quarter. In the last year, if you look at Bharti Airtel, okay, and Kotak, very second decimal, and Bharti Airtel was 1.21%. After dilution, there's still a promoter holding of 52%. In NSE small cap, which is a little more flamboyant kind of an index, you have a sale from HFCL Limited, and after the sale of 4.2%, we still have a 34% promoter holding. So 34% it's not the last mile out, right? And if you go with this, these are the top 5 sales in those indices of 250 companies. Top 5, the 5th top 5 is 1.58% dilution and is left with 53% promoter owning. So that's point 2. Point 3, if Jane Street should not happen in India again, which SEBI has very rightly, under the auspices of great executive directors there who understand derivatives, your cash market has to be liquid. Otherwise, there could be manipulation in stocks using derivative markets. What did exactly Jane Street do? That was already, on your channel, I've said this twice, that it's so easy. If you have 250 stocks in the derivative index, if cash market free float is not there, वो stock move करेगा, put call खरीदेगा, और पैसे इधर से उधर transfer करेगा. You lose money in cash, you make significantly more money. So having free floats creates manipulation opportunity and overpricing. So that's on point 1. Point 2, does the money find back its way in the family offices? The answer, like Ramdevji said, it's absolutely right that it comes back into the capital markets. Point 3 is, I think the money temporarily comes into capital markets. Anybody who is in the business likes to pull that money over a period of couple of years back into doing another business. But Uday Kotakji had actually said that the next generation of those big promoters actually want to just manage the money. So I think immediately 90% of the money comes back into capital markets, 30-40% goes back into the economy, rightly so. And because the debt capital is more expensive today, for the last 2.5 years, repo rates have been at 6.5, and that's why equity valuations plus high interest rates is creating promoter selling. And that's project is viable at equity. You don't need debt for it. So that's why you see they're deleveraged.
Yeah, no, absolutely.